Are you tired of losing your income to taxes? Is the tax man getting a bigger share than he should? Well, income splitting may just be the perfect solution for you. Hold on to your seatbelts, folks. This is going to be a good one. Income splitting is one of the most powerful tax-saving tools available to Canadians, especially when it comes to retirement planning. But how exactly does it work? And more importantly, how can you make sure you're not missing out on those potential savings? We are going to break down everything you need to know about income splitting before and after retirement, from the basics to strategies you can start using right now to save a whole heaping helping of taxes. In simple terms, income splitting is a strategy that allows you and your partner to reduce your overall tax burden by shifting income from a higher income spouse, or common law as well, to a lower income one. By equalizing taxable income between spouses, families can take advantage of lower tax brackets, and, well, that means you're going to save significantly. I am based out of Ontario, so we're going to take a look at an example, and we're going to use some Ontario income tax rates from 2023. Keep in mind, different provinces do have slightly different rates, but overall, the gist is still pretty much the same across the board. If we have our happy couple and one of them is making $100,000 per year while the other is making absolutely nothing, well, at tax time without income splitting, partner number one is paying a whopping $21,590 in taxes. Oh boy, that works out to an average tax rate of 21.73%, though keep in mind their marginal rate is sitting at 33.89. That basically means if they make any more, that is in that 33.89% bracket. Of course, their partner is not paying any taxes and they're not really contributing anything to this tax scenario. Okay, let's look at that same couple, but this time they have the pension income splitting active. So in this case, partner one has shared $50,000 of income with partner two. So they both, in this case, get taxed $6,842 for an average tax rate of 13.81%. And that marginal rate, you'll notice it's down quite a bit, down to 24.15%. In this perfect scenario, they've saved $7,906 in taxes. That's absolutely awesome. And this, of course, is the power of income splitting. Now, in this example, we did a 50-50 split, and that's perfectly fine when you're looking at pension income splitting. There are more rules and there are some regulations if you're looking at income splitting before retirement. So how exactly do we income split in Canada? There are several ways to do this in Canada, depending on, of course, your age and retirement status. There are two main types of income splitting that can be easily broken down into, well, pre-retirement income splitting and retirement or pension income splitting. The core focus in this video will be pension income splitting. However, we really do need to look at the before retirement picture to get a better overview. One form of income splitting that we are not really going to cover in this video is that scenario where a high income partner hires their lower income partner to effectively lower their taxes. The CRA does have tighter rules around this sort of scenario, especially in just how much you are allowed to pay your spouse. If you're making $200,000 a year, you can't just pay your partner half of that for some secretary duties. You must pay them the market salary set for that position by the government. In this example, it means you can pay them around $45,000 per year. Anyway, we will leave that example as is. As I said, that's not the core focus of this video. That would be a separate video for sure. There are more relevant pre-retirement strategies that we do want to look at. So before retirement, the key strategies often involve tools like your spousal RRSPs, of course your TFSA, as well as even lending arrangements between spouses. They can all come into play a role for sure. With a spousal RRSP, it can be very powerful in protecting more of your money from evaporating into taxes. In a nutshell, with the spousal RRSP, the higher income partner will begin to contribute into their spouse's RRSP, and at the same time, get that current tax deduction. One caveat here: if the lower income spouse withdraws this money within 3 years of the contribution into the spousal RRSP, the tax is going to get charged back to the high income contributor. So, yeah, you want to be careful about that one for sure. Keep in mind, later on, after retirement, we are going to be able to do some pension income splitting with that RRSP. So, this is not about taxes in retirement. This is about saving taxes before retirement. That should be the focus of that spousal RRSP. Another strategy that people do like to use is, well, giving money to your lower income partner to invest. There are two primary ways that you can do this. First, and highly recommended, is to give them money towards their TFSA. You are not allowed to contribute directly into their TFSA, but you can give them the cash and they can then contribute, provided they have, of course, the contribution room for it. This is the most ideal of the two scenarios we're going to talk about because there are no taxes involved at all. They can grow that money into more money tax-free in that TFSA. But what if they have no room in their TFSA and you still want to give them money to invest? This time, the CRA is not so forgiving. They will still let you do it, but not as a here's some free money, go invest scenario. They will require that you give your lower income partner a loan that they can use to invest. I know what you're thinking. Oh, sure, yeah, but zero interest. Nope. The CRA thought you might think of that. So they have a prescribed rate that you have to use. In Q4 of 2024, that rate was set at 5%. With this loan, your partner has to pay from their own money each year before January 30th. That interest is then taxable for the loan giver. So in other words, the higher income partner. That low income partner would then pay capital gains and such on their investments as you normally would in a non-registered account. Speaking of investments, a sub to the channel is a great way to invest in future content. Okay, retirement is finally here, and now you are ready to sort out a new world of taxes on pensions, investments, and the like. Believe it or not, it's actually not that complicated. When it comes to pension income splitting in retirement, there are several key strategies that you can use to lower your tax bills and make the retirement income go further. This is mainly a story of pension income splitting. This is one of the most effective strategies to keep the tax man from overcutting in on your pensions. The good news with this strategy is that if you are 65 or older, you can split up to 50% of your eligible pension income with your spouse. This means you can knock those taxes down big time. So what pensions can you split? You can split your RRIF once it is converted from your RRSP, any annuities that you receive, or of course private pensions as well. In addition to all of that, you can also split your Canada pension plan, though it is a separate process. We will get to that, of course, in a moment. The overall goal of income splitting is to level out whatever income inequality is set up by your retirement income. Thus, at the same time, we're averaging out those tax brackets, and that has the effect of lowering taxes. The best way to get a grasp on this is, of course, with another example. So John has just retired from the CNR with a full pension. That amounts to $60,000 a year. He has also converted his RRSP into an RRIF that is paying out $50,000 in year one. He did rather well with his investments. For old age security, he is receiving $9,252. However, there will be clawbacks on this amount as he is making well above that threshold for sure. John is also receiving Canada Pension Plan in the amount of $16,375 per year. So when we add this all up, he is making $135,627 a year. And guys, we're not even counting his TFSA money. That's tax-free. It's not in this calculation, so we're forgetting about it. But yay, good on you, John. This is not a bad amount in retirement at all. For his wife, Linda, she had a less productive financial journey as she raised 3 kids and didn't enter the workforce until much later. She still managed, though, an RRIF payment of $4,800, $8,724 a year in OAS, $2,400 a year in CPP for a total income of $15,924. Unfortunately, in this first scenario, they have no idea about pension income splitting, and they just take the full tax hit. Oh boy. John gets a tax bill of $36,465. Linda, on the other hand, is due for a refund of $1,518. Of course, when they do fill out their taxes, that will get gobbled up in John's tax bill. No worries there. But when all is said and done, they have a total tax bill of $34,947. In a world where John and Linda know all about pension income splitting, they then do their taxes and they fill out the appropriate forms and make the math work for them. All of a sudden, they both have RRIF payouts of $27,400. Thank you, income splitting. They both share John's CNR pension at $30,000 each. Their OAS amounts, those don't change. You can't actually move those about. But their CPP levels, those we can level those out as well. So now, John has an income of $76,039 and Linda has an income of $75,512. You can fiddle with the math and get these dead on, but as long as they both have the same marginal rate, the math is already where it needs to be. So in this example, John ends up owing $14,274, while Linda owes $14,117. This means their total tax bill is now $28,391. So by pension income splitting, they just saved $6,556 from padding the CRA's vaults. That's not too shabby at all. We're not really going to get too much into the OAS clawback, but the income sharing pulling these numbers down will impact that as well. And in reality, we'll probably see a lower OAS clawback. Now, we saw they did save a good amount. Now, that amount can actually get larger when the inequality between the top earner and the low earner gets bigger. In contrast, if you and your partner are making very close to the same amount, this is probably not going to help you that much at all. Okay, now I did mention that there are forms you need to fill out at tax time to make this, well, happen for you. For pension income splitting, you will need to include Form T1032 with your return. It's called Join Election to Split Pension Income. To split your CPP, that one's a little bit different. You can apply online through Service Canada, or you can also apply via mail by completing that application for CPP pension sharing of retirement pensions, which is Form ISP 1002. Just make sure we don't have a mail strike going on if you're going to do the mail route. I hope this answers most of your questions in regards to pension income splitting. Feel free to drop some questions below, and I'll do my best to get back to you in the comments. Let's continue that learning journey. Check out this video on RRSP meltdowns. Thank you for watching, and I will see you in the next video.